Hey everyone. In trading, there are two main schools of thought: fundamental analysis and technical analysis, and the debate over which is better is endless. In this video, we're going to settle that debate, especially for new traders. More importantly, I'm going to show you why technical analysis is so powerful, but only when you understand its core principles. The truth is, most technical analysis out there is junk. Let's get started. Asterisk for those new here. This channel is all about trading, investing, and personal finance. If you have any questions, drop them in the comments, and I'll do my best to cover them in future videos. Fundamental versus technical analysis. Asterisk. So what's the difference? Fundamental analysis looks at economic data, financial reports, and news to determine an asset's value. Technical analysis, on the other hand, focuses purely on price action on a chart. So, which one should you use? The answer is, it depends. They aren't mutually exclusive. They can work together. Fundamentals help you decide what to buy, while technicals help you decide when to buy. Personally, I focus almost exclusively on technical analysis. Here's why. First, I do a lot of short-term trading where fundamentals are less relevant. Second, for long-term investments, I stick to major indexes like the VN30 or top cryptocurrencies like Bitcoin, which don't require deep fundamental dives into individual companies. But the most important reason is this. You can back to this the technical strategy. I can look at years of price data and see, with statistics, if a method works. You can't do that with news or earnings reports. That said, fundamental analysis is crucial if you're investing in specific lesser-known stocks or crypto projects. But even then, you need technical analysis to find the best entry and exit points. The core of technical analysis. The law of bulls versus bears. Asterisk. The foundation of my entire approach is what I call the law of bulls versus bears. It simplifies everything down to the raw struggle between buyers' bulls and sellers' bears. Picture a chart. The horizontal axis is time. The vertical is price. When buyers are stronger, the price line goes up. The steeper the line, the stronger the buying pressure. When sellers take over, the price line goes down. A steep decline means intense selling pressure. The points where the trend reverses are critical. A peak is a bearish strongholder zone, where sellers overpowered buyers. A trough is a bullish strongholder zone, where buyers took control. When the price returns to a previous bearish stronghold, expect a fight. The bears will try to defend their territory. If the bulls are stronger, they'll break through, and that old resistance becomes new support. If the bears are stronger, they'll push the price back down. The strength of these strongholds often depends on how aggressively they were formed in the first place. Reading candlestick charts. Asterisk now. Let's apply this to a real candlestick chart. Each candle tells a story of the battle within a specific time frame. For example, one day. A green candle means the bulls won that period. Price closed higher than it opened. A red candle means the bears won, price closed lower. The wicks show the furthest territory each side reached before being pushed back. By looking at a series of candles, you can see these bull and bear strongholds forming as distinct peaks and valleys. These are your key support and resistance zones. Understanding market trends. Asterisk with this framework. Trends become easy to understand. Uptrend. The bull army is on the march. They are consistently creating higher highs, conquering new bear territory, and higher lows, successfully defending their own territory. The key is that the bull's strongholds are not broken. If a key bullish base is lost, the uptrend is in trouble. Downtrend. The bear army is dominant. They are consistently creating lower lows and lower highs. breaking through bullish defenses sideways market range. This is a stalemate. The bulls and bears are locked in a battle between a clear support bull stronghold and resistance bear stronghold. Neither side can gain a decisive advantage. The best move here is often to wait on the sidelines until a clear winner emerges with a powerful breakout. Why chart patterns work or don't? Asterisk. Once you understand the battle between bulls and bears, chart patterns are no longer abstract shapes you have to memorize. A flag or a wedge is simply a visual representation of a temporary truce or consolidation before the next big move. Asterisk. Take the famous head and shoulders pattern. By itself, it's just a shape. But if it forms after a long uptrend and right at a major historical resistance zone, a huge bear fortress from a higher time frame, it becomes incredibly powerful. It shows the mother bear army joining the fight. But if that same pattern appears in the middle of a strong uptrend with no major resistance nearby, it's likely a trap that will fail. The context, the story of the battle, is everything. A warning about indicators. Asterisk. Most new traders get lost in a sea of indicators like MACD, RSI, and Bollinger Bands. Here's the problem. They are all lagging. They are calculated from past price data. By focusing on indicators, you are looking at a reflection of the battle, not the battle itself. They clutter your charts and distract you from the most important thing, the price. The only indicators I use are ones that help me manage the trading process, like session highlighters or position size calculators. I don't use them to make trading decisions. Ultimately, technical analysis is a tool to help you find high probability entry and exit points, but it's not a crystal ball. Success comes from combining a solid understanding of market structure. This battle between bulls and bears with strong risk management and unbreakable discipline. I hope this gives you a clearer perspective. Now, instead of just seeing lines on a screen, you can see the story, and that will make all the difference.